unashamedly, we've developed a portfolio for retirees because they're a very large part of your business and they're a growing part of your business as well. And this comes out of a fund that I ran over 20 years ago at Westpac, and was trying to be all things to all people, and that was very hard. And what we've done is focus a fund purely or aimed at retirees or tax exempts, which could be charities and other functions like that. And they're not taxed, but they do get those franking credits. And so we think one of the number one reasons to go into Australian shares is franking credits. And I suppose our philosophy is if you can get enough income from your portfolio, you're not going to run out of money if you're a retiree. If you can generate a high level of income, you won't run out of money. But the important issue here is if we look at tax-exempt investors, if you look at the after-tax value of $1 of a fully franked dividend, it's actually worth over $1.40. It's a 40+% pickup relative to any other form of income. They don't pay tax, but they don't get franking credits from anything else. So the only way they can get more tax effective is to get those franking credits. And to give you a bit of an idea of that, and Joel sort of did show some numbers, I'm going to show you 19 years of history, because 19 years because that's when the franking credit index by S&P started. And the capital growth of the Australian market hasn't been all that flash over that 19 years, just 3.2%. So that's right, the Australian market hasn't grown very much, but we are a high income market, and partly because of franking credits, because it encourages companies to pay dividends, whereas in the US, their tax system discourages companies from paying dividends. So if we actually look at the accumulation index over the same time period, the returns look much better, 7.6% per annum, which is the light blue line. But to me, the icing on the cake is those franking credits, and that brings the total return to over 9% over that period. And I think most people have not put franking credits in their returns in the other presentations. Look at it another way, and a couple of clients have said, gee, but Australian shares have been pretty crap versus global shares. So let's just look at those numbers. And indeed, if you just look at the price index over the same 19-year period, you compare it to the MSCI World ex-Australia, or you compare it to S&P 500, which is the grey line, poor old Australian shares here in black are lagging significantly. We haven't had a lot of growth in our market over the last 19 years, call it 20. But price indices don't include those important dividends. And when we add on the cash dividends here, the black line, which is Australian shares, almost catches up to the MSCI World, which is the blue, but we are still a fair bit behind the US. So yeah, that's just cash dividends, doesn't include the franking, and you can only get franking credits from Australian shares. And when we put the franking credits in fact, the black line, which is Australia, is now above MSCI World. And yes, over that 19-year period, we haven't kept up with the US, but that's where the Magnificent Seven is. That's been the best returns. But we've caught up a long way, and we're actually outperforming global shares over that time period. So franking credits are very important. I'm now going to hand over to Pete to talk about how we get a lot more franking credits than if you just had the index, because these returns here are purely index returns.
Yeah, so as Don kind of talked about, franking credits are important to our strategy, and our strategy has two objectives. One is to generate more income, including those franking credits, and the other is to outperform the benchmark. And so and there's two ways to access our strategy. One is our unlisted fund, the Plato Australian Shares Income Fund, and one is our listed fund, PL8, which is listed on the stock market. So in terms of how we've done those two objectives of delivering more income and outperforming the benchmark, here you can see since the inception of our fund in September 2011, the bottom two lines are the income generated by the benchmark in grey and the income generated by our fund in blue. So you can see an initial $100,000 investment has now delivered $100,000 of income in those last 13 years for the fund. And in terms of our total return objective, you can see our portfolio in blue versus the benchmark in grey at the top. And you can see here what kind of a portfolio that we deliver. We're not taking huge bets. We're sticking pretty close to the benchmark, but we're rotating through stocks to generate that additional income over time. And so we have been able to outperform the benchmark as well as delivering more income. In terms of how, because a lot of people are kind of a bit worried given what the media is saying, around the Australian economy and potential recession. So how are we seeing the market for dividends? Well, here we've got a chart which measures the dividend cut probability of each individual stock. And what we've done here is we've averaged it at the whole market level. So we said, what is the probability that any individual stock is going to cut its dividend? And then what's the average across the whole market? And so you can see the average over time of this measure is around 22%. On average, 22% of stocks cut their dividends in any year. However, if we look at it as this line goes up, that means more stocks are likely to cut their dividends. And you can see during COVID in 2020, there was a massive spike in that line. And obviously, a lot of companies were cutting their dividends, some even after they'd already announced that dividend. But then as we controlled COVID very well, the Australian economy had a huge amount of government stimulus. That line came down. And as it went below average, we actually saw a greater than average increase. And we saw a huge dividend period in 2022. Now, more recently, that line has ticked above average. Some of the commodity prices have dropped. Obviously, interest charges for companies have gone up. But we are currently sitting at just above average. And so we don't believe you should believe the media hype around a lot of stocks cutting their dividends. But rather, we think we're in an average kind of period. We're not expecting huge dividend payouts from here, but we're expecting a good level of dividends going forward. So in terms of our fund, we can see that media often clouds things by negativity bias, but we're seeing ourselves in a more normal environment. But we do think it is very important to have active rotation about your portfolio in order to deliver a tax-effective outcome, which can both outperform the market as well as deliver extra income for your clients. So thanks very much, and remember the franking credits.